Glenn Freeman from Morningstar. I'm joined here by Stephen Van Eyk, Managing Director of Stephen Van Eyk Consulting. You've got some quite strong views about active investing versus index investing. Can you just talk me through just quickly your thoughts on that?
A lot of people get the wrong idea that you're one or the other. Right? For a start, you can use passive for parts of your portfolio, and you can be active in other parts if you think that there's value to be added. But also, and I think this is a lot of people don't realise when they look at statistics saying, active doesn't add value over the long term. There are 5 to 6 year periods where it's true. There's no alpha to be added, and that's usually when the market's really roaring along. And I've noticed active managers, the faster the market's going up, the closer they get to the index. Because if they take a stand and say these companies aren't worth that much money, and they don't buy them, and then the market continues to rise strongly, they're going to underperform quite a lot. So basically, in a market like that, you're wasting your time with active management because they're not doing anything away from the index anyway. However, in a market that like we've had over the last few years and like we've got at the moment, where really market performance is 5 or 6 if you're lucky, and pretty volatile as well, I've noticed that managers move a lot further away from the index, and there's been some big opportunities for active management. For a start, China was always going to slow, wasn't it? Economic theory says China was going to slow. So what's going to happen to resources? They're going to go down. In the Australian market, that's if you're not holding resources, you really outperformed for the last few years. Banks, after 2008, obviously the authorities were going to bring in a lot more regulation on banks, which was going to cut off a lot of the areas that they could actually make money from. So they used to be utilities, and then they went to be growth stocks, and now they're going back to being utilities again. So obviously in the Australian market, if you didn't go in banks and they went down, you were going to outperform the index by a mile. Internet stocks, selling pizzas, etc. They were the big thing for a while. You go into those, you make money. In other words, there's been tremendous opportunities to actually outperform the index in active management in Australian stocks. So it goes in periods. If you take 2 periods end on end and for, say, over 10 years, well, one cancels out the other, and it probably says active management doesn't have much value. But if you get the periods right. And the point is there are signals that can tell you when it's time, like dispersion of stocks, price dispersion, the highest value from the lowest values, telling you whether there's a bang for your buck in actually getting out of some stocks and into the others. So there are signals, and if you see them coming about and you start putting more in active management, if you've been indexing or vice versa, you can make more money for the same risk.